but now joins us. Good morning, Jyoti. Thank you very much for joining us. What's the sense you're getting of the overall markets itself, the volatility we have seen on Wall Street as well, the big losses for consecutive days and the one-day recovery up to about a third of the losses? Is this indicative that the worst is over, the bounce back, or we are still going to see it play?
See, the bounce back, we have to look in the light that the market had got oversold. We had like a long period of sharp losses. To that extent, you typically expect a bounce back after such markets. From an investor point of view, these are times where you have to probably invest slowly and, buy every dip. I don't think it's like, can we say that the market will never go below these levels? It probably will over the next few weeks. But the markets are probably going to try and consolidate. It's good that we've had a correction, because if you see, any period, in any 18-month period, you probably have a 10% correction in the market. There was one overdue. Markets were like consolidating in a range. So I think we've got that consolidation period, which, everyone was hoping would come through.
Okay. Jyoti, hi, good morning. But do you think that global deflationary pressures are perhaps a big threat to the equity market growth here on?
See, it is, I guess, what we are seeing just now is like a realization that the world is going to be a much slower place than it used to be. China, which was the growth engine for the last 15 years of the economy, is clearly slowing. It is something which, a lot of us have been talking about for the last 2 years. But now, that whole step of the currency devaluation was an admission that, they're finding it very difficult to have growth come back into the economy. And so I think the world is adjusting to the fact that it's going to be a slower place. Ironically, falling commodity prices are great for India, right? Because it helps the economy in a very big way. But it is a mixed blessing. That's what we have to remember, because if you look at markets are actually very positively correlated to oil prices, not negatively the way one would have thought. Which means, if we look at history, when oil prices go down, the markets tend to go down. And that's because of just the way the world is. When you see oil prices going down, you end up into the situation where most of it is signaling that the global growth is going to come down. So it is a mixed blessing. It is good for the economy ultimately, and so it will help the stock markets. But near term, a very steep fall in oil prices is typically accompanied by markets not doing well.
Oh yes, that's true. How would the mix of investment picks look like now? Jyoti, you've long tracked the oil and gas space. Should your 100 rupees of investment avoid commodity stocks for now?
See, in general, one should avoid commodity stocks, so they are not places where one wants to be. Now, of course, in India, when you look at the oil commodity stocks, the oil public sector marketing companies, which for a long time have got burdened with subsidy and were not getting margins which were really good. So that's one space which will still do well, though I think a lot of the returns in that space have still got made. But over the next 6-8 months, I would still be positive in some of the oil marketing companies. Otherwise, in general, I would avoid the commodity space.
Okay. Would you be high up on the export-oriented, say, dollar-oriented stocks, basically IT Pharma?
Yeah, I would be, at least for the near term. I would be overweight all the exporters simply because of the rupee and, the benefit they'll get from the rupee. These stocks have done very well, so they're not cheap. But, at the moment, they probably stand out because it gives you a bit of hedge against, another possible currency weakness coming through. So, that would be one segment I would definitely be overweight on.
Okay. I'll come back to individual stocks in a bit, Jyoti, but just wanted your view on whether you fear, further large-scale selling from emerging market ETFs, because since Monday, we've seen emerging market ETFs see at least $16 billion of selling. Given that, we have these growth concerns, could we expect to see more?
It will be all part of a very global thing where, people are getting nervous on markets globally, and especially when commodities tend to come down, though India is like a little bit different. India benefits with commodity prices going down. Most emerging markets, struggle when commodity prices go down. So just on a macro theme, the theme would be if, commodities are under pressure, growth is a question mark, then you don't want to be in emerging markets, you'd rather be in developed markets. So India may be relatively much better than, most other countries in the world, and that's something which most people accept, that India will come out of this stronger, India will relatively be better. At the same time, we will be part of a global sell-off. So to that extent, we will see foreigners pulling out some money if that is just a global phenomena.
So how do, as an investor, how would you approach this? Before I come to how a trader should approach this, would you buy the big large caps which were never available at bargain prices becoming slightly cheaper? Would that be your area of concentration, or would it be the gems in the mid-cap space?
Yes, essentially what you have to think is over the next 1 year, 18 months, if domestic growth is going to be quite good, and just remember, a lot of commodity prices are coming down, so input cost pressure are going to ease for a lot of companies. Look for people who will gain from either, a weakness in the currency or from lower commodity prices, and, look at valuations and buy them. Just from a mid-cap versus large-cap perspective, on a very broad brush, mid-caps had become quite expensive relative to large caps. So to that extent, large caps were looking much better. But the correction in the mid-caps is going to be also, I think, much sharper, and that's typically the case. So maybe you'll start getting mid-caps also at attractive prices. But at the moment, in general, large caps are looking better than mid-caps on a valuation basis.
Okay. Just coming back to that point you made about pharmaceutical stocks that have done very well but are not cheap at this point. But going ahead, say, if someone has a 6 months to 12 months horizon, do you think it still makes sense to increase allocation to some of these large cap pharmaceutical names, the likes of Lupin, etc., just because there is some amount of stability as far as earnings are concerned?
Yeah, especially given what's happened to the currency, it's added probably to the earnings safety outlook in these. So to that extent, I would still be adding to pharma. That's one space which, I think will still be attractive over the next 1 year.
Okay. Jyoti, finance stocks, finally. Where would you place your bets? Would it be safer to go to NBFCs at all? And then, of course, the inevitable question on PSU banks.
Yeah, so I guess, the very general consensus, and I'm part of that, is the private sector banks are the easy ones to play, so you keep playing the private sector banks. On the PSU banks, I think, there will be a time to buy them. They are cheap, but I think, we probably can wait for another few months, wait for a little more signs that the economy is turning around, because essentially what, the whole global turmoil is going to do is probably tend to delay the recovery a bit more. So to that extent, there's no hurry to jump into the public sector banks, but they are at a situation where they are looking quite attractive if we start getting a turnaround in the economy.
Okay. Would you buy HDFC, Jyoti? I mean, it's flat year to date. It's month to date down 14%, 15% actually, and week to date it's down 7%. There seems to be some concerted selling in that stock, delivery-based selling, probably even by FIIs in the past few days. Should it be a buy in distress call?
Yes, see, some of these, high quality stocks are well owned by most people. So what happens is when a selling comes, people do tend to sell some of these stocks which are owned a lot. Business-wise, things look good, and it's a stock which, one should hold for the long term. So to that extent, I would be buyers and corrections in these sort of stocks.
Will Tata Motors also feature on that list, because that stock has been severely derated as well? Is this the time to buy it?
See, I'm worried about anything related to China, so whether it's commodities, whether it's cars, because, the China demand is going to be a question mark. So to that extent, I have been generally trying to say avoid anything connected with China, because we don't know how long the pain can last. But typically when such things start coming off, the pain is much more than what people anticipate at that point of time.
But you know, Jyoti, the expert view is that Chinese infrastructure demand will be next to nothing because they're over-invested there. But they are wantonly trying to increase consumption. This is what most of the economists, not the market guys, most of the economists who specialize on China studies tell us. So, you know, Tata Motors really doesn't get punished because of their over-investment in infrastructure. If anything, it gets helped by it. And even the recent bunch of measures was very kind to financial and leasing companies, especially to auto finance companies. You still think that Tata Motors is dangerous picking?
Yes, you know, like what they're trying to do is change the way the economy has functioned. So in last 15, 20 years, they've been totally investment-led. The investments became like close to half of the economy, which, you know, by itself rang alarm bells. Now, it's not very easy to have the switch on, switch off, where you say, okay, you know, we are investment-led and from tomorrow we've decided to be consumption-led. Because two things we have to remember, it is a more centralized economy. So the investments were easier to come because, you know, that was led by the government. Consumption can't be led by the government, it will be more individual. And they may not buy as easily because they may just say, okay, we are worried, so we want to wait and watch. So government can only take the measures, but it's not easy. You know, you pump in money, you cut interest rates, but beyond that, it's not easy to change the economy. So to that extent, things may take longer than what one anticipates on this front. And that's the thing I'm worried about, because you've never had like too many occasions in the world over the last like 100, 200 years where we've seen the economy suddenly change gear and come out very smoothly in a very short span of time. It always takes some time.
Okay, so finally then, because, you know, one should perhaps at this point stay away from export-led stories, is it better to go with the domestic growth stories, however expensive they are? I mean, names like Asian Paints, HUL, Maruti, etc.
Yeah, so, you know, my view would be buy domestic-led stories and buy some exporters. So basically, you know, you have a bit of exposure to software and pharma, and then you have exposure to the domestic growth stories. So basically, it would include banks, it would include autos, and probably some of the consumer names. So that would be the ideal mix to have.
All right, Jyoti, pleasure speaking with you as always. Thank you very much for dropping by today. Okay, the markets have held on for the first 25 minutes, no, actually 30 minutes with that almost 1% gain. 7,900 is still within reaching distance, stretching distance, though of course it's moved away about 50-60 points from the opening high of 7,920. No complaints even with current levels if they can hold. We'll take a break on that note. But coming up,